Hi folks, my name is Sujoy Barden and I had been working in finance for over 7 years in Singapore. I've worked in IT for over 15 years in USA. I've worked with traders in Wall Street area and the banks, helping them with IT based strategies and automations. I've used both stock market trading skills and IT experience to develop a predictive model which is capable to run in 42 exchanges around the world, optimized over 12 years now, trading live with it in US stock exchange, and also helping investors with breakout information. I specialize only on long-term positions in equity market. I had been doing this in Indian exchange for a while. I also hold a professional degree from India. Every day breakout happens irrespective of the market conditions and they rally for few days. This happens mainly because of investor sentiments, which could be strong due to its individual stock's performance. It could be for some other analyst projecting the stock to be a buy, or it could be a dividend or a split which has been announced. But bottom line, even on a bear market conditions, you would notice some of the stocks take a spike. And sometimes you may even ask yourself a question: why is it that what it takes to identify those ahead of time, and wishing one could invest on even those stocks which are rallying on a bear market. Of course, stocks rally on bull market a lot more than ones which rally on a bear market. But the skills needed to identify those is all about the research which I had been doing for last 12 years. Now, what is a breakout? Breakout happens when a particular stock starts taking a spike, and this spike could be for few days. It goes on, and as soon as the reversal happens, you exit out from that stock and reinvest that money into some other stock which is taking a spike. As I said, spikes happen every day, irrespective of the market conditions. The skill is to identify that ahead of time. So as soon as you identify another spike happening on some other stock, you circulate your money into that particular stock, rally for a few days, and then exit out as soon as a reversal happens. And you continue doing the same rotation again and again. So to identify those ahead of time is the key, and being able to rotate the funds as quickly as possible, as to what I have just explained, results to high return on investments. Of course, there is a risk strategy which I will talk about it later, but this is all about rotating, identifying the spikes, rotating your funds as quickly as possible in multiple stocks, as so that what happens is, at the end of the day, you are making your money work every day for you where the spikes are happening. So what it takes to identify these breakouts: number one, of course, the research which has been going on for 12 years. This research been translated into information technology so that one can identify the breakouts from the US stock exchanges, where thousands of stocks are being traded every day. Along with it, the best practices and methodologies, which I will talk about in later slides, will bring in a guaranteed return of your investments with a zero cash loss strategy, which I will explain in a minute. So, having said that, investment is nothing but 100% mathematical calculations, where sentiments, human sentiments, emotions do not work. Strictly based on discipline and a proven methodology along with best practices would help you to achieve such returns on investment. Here I will try and explain the strategy of zero cash loss strategy. First of all, let me explain that what are the type of stocks we are scanning to look for breakouts. Number one, these stocks are the ones which are filtered with very high fundamentals. So practically from thousands of stocks, like 10, 12 thousands of stocks, we are bringing it down to probably around 1500 stocks to scan based on fundamentals. So okay, you can imagine that how strongly and what is the basis of filtering those stocks based on fundamentals. Secondly, these stocks are all over $1 billion when it comes to market capitalization. And thirdly, they all have a very high average volume. So hypothetically, we can say that these are the stocks which comes within the categories which we well known as like Facebook, Amazon, Yahoo, Google, Bank of America, and so forth. So having said this, with these type of stocks, what is the probability that their price, say for example a particular stock is $45, what is the probability for these stocks, as I've just mentioned, to go down to zero? Almost none. So this is the type of a risk which we take considering the fact that these well-known stocks would not go down to a price where the share value is zero. So having said that, this is where what we talk about zero cash loss strategy. So if I am looking for breakouts within these stocks and I am only exposing myself to $4,000, the worst scenario which can happen is if those stocks or any of that stock goes to zero, I am only losing $4,000. But on the flip side, and this can happen once in say 3 years, 4 years, where you have already traded few hundred stocks based on the recommendation. So if you have, on the flip side, if you have even made some $50,000 and one such stocks mentioned here goes to zero, the risk is you're only losing $4,000. So as an example, I can also say that when we are driving a car, the moment we get the car onto road, we are already exposed to risk. Somebody can come and hit us, or something can go wrong and we get into an accident. But driving a car does not mean that we will get into an accident. An accident may not even happen a lifetime. So this is the same scenario with investment strategy, where these stocks which I have mentioned, which are very high profile, high end stocks, will never get to zero in a lifetime. So having said that, this is the technique which has been used in this methodology, where the portfolio amounts are spread equally over multiple stocks to look for breakouts, and the risks are minimized to this to an extent of $4,000 in this example, where a potential cash loss could happen only if these healthy stocks could go to zero, which is very unlikely. So therefore, investment is purely mathematical, where human emotions do not play a role, and it is strongly recommended that not to over invest over $4,000. Don't bring human emotion and put in $10,000 in this case. That way you might be landing up with excess capital blockage, or you could land up into a risk which I have just mentioned now. But if you keep your portfolio controlled and do exactly what is being recommended here, the chances of losing money will only happen if those stock or those symbols or those stocks goes to zero. So if you believe in this concept that these stocks can hardly be zero at any given point of time, which has very strong fundamentals, very strong market capitalization, very high volume, then you are already mitigating your risk to almost zero cash loss strategy. Here I will try and explain how one can generate the ROI from the breakouts on a bear market and how these circulations of funds happen to generate this ROI. So having said that, assuming that one is investing around $25,000 with a spread of $4,000 each, so you would be getting around 6 recommendations a day, 131 recommendations a month. Now usually from our research which you would also get to see on our website under performance, it so happens that 5%, this is on a bear market condition, 5% of the stocks would either settle on the same day or the next day, which means that you are rotating around 7 recommendations from this first category. This 7 recommendations would generate around $591 as a return on investments, where you have invested already 26,000. So this is the beauty of this. With the help of rotations, although your principal amount is only 25,000, but from the very first layer of settlements, which is happening within 0 to 1 day, you are investing on 7 stocks, which is almost equivalent to 26,000, much more than your investment amount, which generates around 2.25%. On the website, as per the actuals, it is around 3% plus, but we have kept the conservative number. And having said that, it's already generating around $591. The second settlement happens within 30 days, which is around 55% of the total recommendations of 131 stocks, which means you have settled around 72 stocks where you have invested around $9,600 and you are generating around $217 as a return. The next slot, which is 20% of it, happens within 60 days, where you are generating around 26 recommendations have settled in this category, where you are generating around $39,000. So if you take this total of the investments, you have already invested and rotated $38,500 from your original $25,000, which is roughly around 1.54 times of your original investment, which is adding up to around $866 as a return. And these are monthly, because you are looking at a monthly number here, which is equivalent to around 3.47% on a bear market conditions. So generating 3.47% on a bear market with such high rotations, where roughly 60% of the stocks are getting rotated, out of which 5% are rotating every day, which is equivalent to $26,000 of worth of investment, repeated investment. It gives you around 38.12% return per year in 11 months. Why 11 months? Because we serve around 11 months in a year where 1 month is kept for us to optimize our algorithms or find research findings throughout the year, which gets inbuilt into the algorithm for better performance, and also vacation time. So even if you take 11 months scenario, you are generating around 38.12% as an annual return on investment on a bear market condition. Now let's take the case of a bull market conditions. How does the ROI get generated due to the funds being rotated? Here again we are taking the same example of 25,000, where you are getting 6 recommendations a day, 131 recommendations a month, spreading it equally over $4,000. So on the settlement which happens within the first day, within the first 0 to 1 day, is 20% as compared to 5% which was in the bear market condition, resulting into 26 settlements. These 26 settlements amounts to around $105,000 worth of reinvestment, which is generating itself $2,300 as return on investment. The remaining 30%, within 30 days, 60% of it settles, which eventually generates around $239. So having said that, if you take up all these categories and add up to the ROI which you are generating from all these categories, you are looking at $2,628, which is roughly around 10.51% as compared to 3% on bear market condition. So if you take a look at the rotation of the funds, you are rotating your funds much faster, almost 4.67 times on a bull market condition. So that's the idea of this research, to identify the breakouts as early as possible, trade with it, as soon as reversal happens, exit out and get into the next trade. So if you keep doing this and you maintain 6 recommendations on an average, you are looking at 131 recommendations a month. On the assumption that you are keeping 6 recommendation every day as a baseline, you are generating around $28,900 a year in 11 months, which is equivalent to 115%. Sounds unreal, but it is true. These numbers are proven numbers from real-time research and trading, which you can witness on the presentation in terms of how the breakouts happen and how they hit the target price and the type of an ROI it generates within that duration. So in the performance tab on our website, you will see the ROI it generate and the duration, which is basically spread into this scenario depending on the analysis of how many shares are settling, how many settlements are happening within a day, within 30 days, within 60 days and 120 days. So having said that, if you adopt this technique based on the recommendations, you are making money under all circumstances under bear and bull conditions, where the percentage may vary from 3% to around 10%, and not to mention again with a zero cash loss technique. So if you believe in this, you can try it out. I'm sure you will not regret. It's, as I said again earlier, that investment is nothing but purely mathematics. You cannot be greedy. You cannot bring in human emotions into it. If you stick strictly based on these numbers and let the settlement happen on its own based on this criteria, you are making a pretty significant ROI here. Here I'll be talking about investment techniques, keeping emotions in control, and if you can do that, you are guaranteed with returns. As an example, which I've taken in the previous 2 slides on a bear market condition and bull market conditions for an investment worth of $25,000, you are looking at 6 recommendations. So what does it mean when it comes to best practice? So whenever you take this recommendation, the day you begin is the day you are spreading your 25k portfolio equally into 6 recommendations. By the way, this can be also for $12,000, or it could be even for $50,000, or it could be even more depending on how much you would like to invest. Everything would boil down to the number of recommendations, which means that you are spreading your risk into equal investments across the portfolio. So having said that, 25,000 is what you are spreading into 6 recommendations on the very first day. Assuming on the second day one of it gets settled, say the third recommendation got settled with a sell-off with a target price, it makes it to the target price and it exits out. you have made money on this particular trade. So although you'll be getting daily recommendations, but you'll be reinvesting again on one more stock only, which means that at any given point of time you are maintaining 6 recommendations for 25k portfolio. Say on day 3 nothing happens, so you do not invest anything if the market is bear, although you might have recommendations with you on your login website once you get the login. Say on day 4 the market happens to be more bull, 2 of the recommendations settles, say 1 and 5 gets settled, so you'll again be investing again on only 2 new recommendations. So this is basically the methodology and best practice where you are controlling your investments without emotions, spreading it into equally into 6 different stocks, waiting for breakouts to happen. As and when breakouts happen, it settles, you only reinvest on those stocks. So this methodology and best practice would lead to the following. One would be controlling the portfolio spread into equal investments and take positions only on the stocks when settled. So if you follow this practice, as I have said earlier, even if you take a 5% scenario of settlements happening, you would be generating around $591 from 25,000 worth of investment, where you would have reinvested around 26,250. But on a bull market condition, the same settlements which is happening within 0 to 1 day could be 20%, which means that you are probably reinvesting 26 times, which is equivalent to 100,000 plus type of an investment with your original 25,000 investments. So you are making few folds of investment only in this category itself, which itself would generate $2,360 roughly. So having said that, if you're looking at around 25k portfolio with a bear and bull market conditions, which is giving you a return of around $590 to $2,300 range. So this would again depend on the bear and bull market conditions. If the market during a month is more on the bear side, you will be around this range. If it is more on the bull side, you will be around this range. So irrespective of whatever the scenarios are, you're still making money under bull and bear conditions with the breakout informations which you would be getting every day. Previously we did speak about how you spread your investments equally for the portfolio, and as and when a certain investment settles, you take position on the next one based on the recommendation. So if you do that, the research leads to more breakouts. That is the exercise which we do at our end to identify more and more breakouts for you, so that the recommendations are spread equally over multiple stocks to spread out your portfolio, which means that you are lowering your risk to a point where you could get into a situation that where you might lose $4,000 only if the stock price goes to zero. So what are the chances? Maybe none in years to come. So where a company like Facebook or Amazon or Yahoo, Google, Bank of America would hit a stock price which goes to zero. So as said earlier, the breakouts which are happening are from very strong fundamental stocks, very strong technical indicators. It has a market capitalization of over $1 billion. It has a very high average trading volume. So basically these are probably the best and the healthy stocks in the exchange, where you have to be comfortable in assuming that the fact that these stocks will never get down to zero. So if you believe in that concept, then you're mitigating your risk to almost none, and then you are leveraging from the number of recommendations which is coming to you every day. So what matters most for the ROI? is a successful breakout hitting the target price at all times. So you would notice that most of the recommendations, in fact all the recommendations which we provide, is hitting the target price. The question is how quickly it is hitting. As said earlier, you have seen the spread. Almost 10%, 5 to 10% of it is hitting within 0 to 1 day. Over 50% of it is hitting over 1 month. So these two component itself is generating the ROI for you, which I have explained earlier. So the first thing is the number of breakouts. So you're relying a lot more on breakout information. Number two, these breakouts are hitting quicker and faster for fund rotation. So if these two combinations are there all the time, there's no way you would not make significant ROI. You will definitely make pretty significant ROI based on these two combinations. So the sweet spot for investment per stock would not only generate ROI, but it would also keep your commission for the brokers very low, and at the same time avoid liquidity in the exchange. So research says that 4K is the sweet spot for every investment, but definitely not more. What it means is, if you're buying stock worth or investing on a stock worth 4K with around 2.5%, you're roughly looking at around $100 roughly, and you're paying commission to a broker. So that is something which you have to take out from the profit which you have made. So we strongly recommend that you use Interactive Broker. You can use any, but Interactive Broker would be a very economical scenario for you, where you are only paying roughly around $2 to $3 as a round trip commission. Because with the $4,000 investment, which is the sweet spot for the recommendations, you would be buying roughly around less than 200 shares at a time for each of the recommendations. And Interactive Broker's commission for something around less than 200 shares would be around a range for in between $2 to $3. If you compare this with other brokers, you will be probably paying a lot more. So ROI, commissions would eat up ROI. So you have to be careful in what broker to select. But as per our recommendation, Interactive Broker would be an ideal solution, where you are depending too many breakouts, and at the same time you are keeping your commission low. For example, if you are investing on say 10 stocks with say $3 round trip commission, you are probably spending around $30. But if you take other brokers where the round trip commission or one-way commission is $7.25 or $3.50, you will be as a single trip, round trip commissions would be much more than what you would be paying through Interactive Broker. So the most important point from here is you are relying a lot more on breakouts. You are spreading your risks equally. Since you're relying more on breakouts, you're looking for a broker as recommended who would give you the cheapest commission. These three things combined together would help you to generate ROI. But at the same time, you're on the risk side of it. You're picking up the most healthy stocks, and as an example, Facebook, Amazon, Yahoo, these stocks will hardly there be a scenario that they are going and hitting a price at zero. So even if that happens hypothetically, since you're controlling your funds to only 4K, that's the max you'll be losing. So again, you might be making, this will happen probably once in 2 years. Let's assume that. I haven't seen anything of this sort happening, but even if we assume that this happens once in 2 years, you'll probably be making in 2 years few thousands. So you'll probably be losing around $4,000 only. So this is the way it mitigates the risk. This is the way it's been strongly recommended to use brokers who are economical, so that you take the most advantage of the ROI. Here I will try and explain based on the methodology and best practices, which includes zero loss techniques as explained earlier. What can one expect as a monthly ROI? Monthly ROI depends, and it goes within a range because of the bear and bull conditions which happens at regular intervals. It ranges in between 3.47 to 10 and 10.5%, but again that might change probably in next 5 months or 6 months, depending on how bear and bull the market is. Having said that, the fund rotations, the ROI which is so impressive on a monthly basis is mainly because of the fund rotations, which is happening at regular intervals from the breakout informations. Uh, as explained earlier, between 5 to 30% of the funds gets rotated within the same day or next day, depending on bull or bear conditions, and 50 to 60%, 50% of it gets rotated within 30 days. So this itself results from the first category itself. The reinvesting can go up to 60% of the original portfolio amount. I'm sorry, from the first two categories itself. So if you are investing like $25,000 at the from the first category itself with 10% or more, around 10% settling within 0 to 1 day, you would be reinvesting that money more than the original investment amount, which would be more than 25,000. So the gist of it is, with the help of breakouts, identifying the breakouts and the funds, and it the recommendations hitting the target price within a very short time and being able to reuse the fund is the key for ROI. So the numbers are right in front of you. You can take a look at it at your speed. But at the same time, the best practices, what I wanted to mention is not to over invest by using the same recommendation, as that might lead to capital blockage and higher risk. It is highly recommended to spread the recommendations equally into several stocks to mitigate risk and higher chances of breakouts, which may happen from the target price and faster fund rotations. Uh, Sometimes you might have a tendency to use the same recommendation for a higher portfolio amount. So that is something which you should avoid, because that way you would be overexposing yourself. So if you are moving from 12,000 to 25,000 portfolio, you are better off to have 6 recommendations instead of 3. So that way you are spreading the risk into variety of buckets equally. If you are moving from say 12 to 50, you are better off to use 13 recommendations instead of 3, because you'll be spreading your risk and the chances of breakout into 13 possible stocks at any given point of time. So if you bear that in mind and rely more on recommendations based on the portfolio amount and spreading your risk equally, the ROI tends to be better and has been better. So each recommendation is expected to be around 2.25%, but this can fluctuate. This depends again on the research which is continuously going on, which you would see on the performance tab on our website. But as a ballpark, this gets reviewed every 5 to 6 months to see if there is any deflection in the ROI averages. But if you go to the performance tab, you will notice that each of these recommendations, how much they are generating as an ROI and what is the duration. So having said that, if you look into all these things together with zero loss techniques, spreading the investments equally into multiple buckets, and then relying a lot more on recommendations to go and hit the target price, the the ROI is pretty significant and you can experience it on your own. So the final conclusion, of course, the predictive model's intelligence to identify the breakout information and to leverage from it. As said that we are already scanning around 1500 stocks a day, uh, out of 12,000 stocks in US stock exchange. So these are the very healthy ones. So the chances of things going wrong may be very uh, uh, unlikely. Spreading the investment equally to mitigate the risk. That's another important point, because you don't want to put all your eggs in one basket. You're better off to spread the risk equally and to enjoy the ROI from the breakout informations which is happening. As said, and you will notice in the performance tab, sometimes some breakouts takes us to a target price of 2%. Some of them can even go up to 7%. So you're better off to spread it equally and leverage from the ROIs which is getting generated. So if you are lucky on a bull day, there may be two or three uh, recommendations or breakouts with over 5% as a target price, and all maybe would be hitting the target price around that percentage. So you're better off to spread the risk equally and get more recommendations if you increase your portfolio. Reducing the number of shares to each investment ensures the fulfillment. That's another important point. By keeping your investment to the sweet spot of $4,000 each, you are restricting your number of shares, which basically would ensure your order fulfillment and also a low commission if you're using interactive broker. Maintain a very low probability of risk to loss, which has been explained earlier in terms of zero loss strategy. Any investment is risky, but unless that risk gets converted to a loss, it's still a risk. But the in the real world, as I said, when we drive a car, we are always at risk when we are on the road, but that doesn't mean that the accident is happening. So the same here, it's been mitigated to such a way that these stocks are healthy stocks. It's very unlikely that it will reach a zero. So a risk to loss scenario is very unlikely. Increase portfolio based on a more number of recommendations. As you increase the portfolio, increase the number of recommendations and maintain that probability of settlement, which will increase the ROI potential. As said earlier, that if you are moving from say 12k to 25k portfolio, in 12k you are taking 3 recommendations per day. On 25 you might be taking 6. So do not just stick with 3 recommendations per day, because you are overexposing yourself if you do that. And secondly, your chances of breakouts which might happen from other 3 stocks which you have not leveraged from could be also another issue of your ROI to get impacted. So as you increase the portfolio, please make sure that you also increase the number of recommendations, because that is going to not only mitigate your risk, it is also going to handle liquidity issues. It is also going to handle your order fulfillment. It's also going to handle your low commission from that perspective. So a proven technique as shown on the videos, if you go to the website, on the videos with real-time data and also the concepts with mathematical calculations, and of course outstanding predictive model for target price projections with breakouts. Whatever this algorithm projects with the breakout with the target price, it goes and meets that. Sometimes it reaches the target price in the same day or the next day. Sometimes worst scenario cases it takes probably 90 days, but majority of it is within 30 days. 60 to 65% of the recommendations are settling within 30 days, so which adds up to your ROI. So having said that, this research based on my research over years, I've come to a conclusion that investment is purely mathematical and it is not a gamble. Where, but if one keeps the personal emotions in control, the results are pretty significant when it comes to ROI. But if not done correctly, investment can be risky if it is not done correctly. So if you believe in this strategy, where I'm saying that it's a zero loss techniques, where the stock prices can hardly go to zero, relying too much on recommendations for target prices with a shorter duration, and continue rotating your funds as quickly as possible to generate ROI, feel free to join this club. You will definitely not regret it. So it's a school of thought, right? Investment is all about what school you come from. So these few things which I just spoke about is the school of thought. You can take it as a school of thought from the research which has been happening over the last 12 years. So thanks for listening.